Most people woke up on February 2nd, 2026, expecting a normal trading day. No emergency alerts, no crisis summits, no countdown clocks on financial news. Just another morning where screens turned on, coffee cooled beside keyboards, and money moved the way it always had, quietly, invisibly, assumed. That assumption was the most fragile part of the system. For years, markets had operated on a simple belief: if something went wrong, liquidity would appear. Central banks would step in, credit lines would open, someone, somewhere would stabilize the damage. That belief didn't come from theory, it came from repetition. Every shock had been answered, every wobble softened, every panic reversed. Over time, rescue stopped feeling conditional and started feeling permanent. February 2nd didn't begin as a crisis. It began as a test. In the early hours, silver prices started to slip. Nothing dramatic. Markets move every day, and seasoned traders are trained not to react to the first drop. Volatility is noise, until it isn't. What followed wasn't noise. Liquidity thinned faster than expected. Bid depth vanished. Orders that normally absorbed selling pressure simply weren't there. Within hours, silver was down more than 30%. Gold followed, not slowly, not gracefully, but mechanically. To anyone watching their account balances, it felt personal. Assets marketed as protection were suddenly inflicting the most damage. Screens flashed red, alerts fired. Positions that felt long-term the night before were suddenly liquidated without permission. The same question appeared everywhere. How did this happen so fast? The explanations came immediately. Profit-taking, technical breakdowns, overcrowded trades. They sounded familiar, professional, reassuring. They also didn't explain the speed. They didn't explain why selling felt forced rather than chosen. They didn't explain why the drop ignored traditional support levels. And they didn't explain why the panic seemed so one-sided. Because while traders in New York and London were scrambling, selling whatever could be sold, other parts of the world were doing something very different. They were waiting. No emergency statements were issued, no calming reassurances were offered, no promises were made that stability was on the way. In places where money is still treated as something physical, not theoretical, buyers watched the collapse without reacting. They understood what Western markets often forget. This wasn't a verdict on value, it was a liquidation. Leverage had been building quietly for months. Margin levels crept higher. Volatility stayed artificially calm. Risk felt manageable because it had been managed before. But leverage only works when liquidity is guaranteed. The moment that guarantee becomes uncertain, leverage turns from advantage into liability. Positions that looked smart under abundance become dangerous under restraint. That's what happened on February 2nd. Margin requirements rose, credit conditions tightened. Traders who had borrowed to hold positions were given a simple choice: add cash immediately or sell. Most didn't have cash, so they sold. That selling triggered stop losses. Algorithms followed momentum. What began as stress became a cascade, not driven by opinion or fear, but by structure.
At the same time, another unwind was happening in parallel. Crypto markets were being drained. Billions in leveraged positions were being closed. Investors chasing liquidity sold whatever could be converted fastest. Gold and silver became collateral damage in a broader scramble for cash. But the most important activity wasn't happening on trading screens, it was happening off them. As paper prices collapsed, physical metal quietly became harder to obtain. Premiums widened, delivery times stretched, inventories thinned. In Shanghai, in Mumbai, in Moscow, buyers stepped in, not emotionally, not impulsively, but patiently. They didn't react to headlines, they reacted to math. They understood something fundamental. A falling price doesn't always mean something is failing. Sometimes it means ownership is changing hands. In Western markets, gold and silver are often treated like ideas, numbers that rise and fall on screens. In other parts of the world, they're treated like insurance, something you don't question when trust starts thinning. That difference matters, because while one side of the world was being shaken out of leveraged claims, the other was quietly taking delivery. This behavior didn't appear overnight. It had been forming for years. Central banks accumulating without press releases, trade settlements adjusting quietly, infrastructure being built without demanding attention. February didn't create these trends, it exposed them. What made February 2nd unsettling wasn't just how fast prices fell, it was what didn't fall. There was no immediate rescue, no policy pivot, no signal that relief was guaranteed. And that absence carried more weight than any announcement could have. Around the same time metals began unraveling, something subtle shifted in the background. Not officially, not ceremonially, but psychologically. A name started circulating through financial circles, Kevin Warsh. To the public, it meant nothing. To markets, it meant discipline. Not because of an announcement that morning, but because of what he represented. A philosophy that inflation isn't a technical error, it's a failure of restraint, that markets need consequences to function, that money loses meaning when it's endlessly softened. Markets don't wait for policy, they react to intent, and the intent felt clear. The safety net might not appear. Once that belief cracks, behavior changes immediately. Leverage stops feeling clever, risk stops feeling abstract. Assets built during years of accommodation suddenly feel exposed. This is why metals were hit early, not because they were weak, but because they were crowded. They were owned with borrowed money. They were treated as trades, not holdings. Forced selling doesn't ask whether something is valuable, it only asks whether it can be sold. Meanwhile, systems designed with limits already embedded responded differently. They didn't panic, they recalculated. They absorbed stress without demanding reassurance. That contrast revealed something deeper than a market move. It revealed a misunderstanding that had lingered for years. Many people assumed that if a new reserve framework ever emerged, it would look familiar. Another dominant currency, another hierarchy, another symbol printed on paper. That assumption was wrong. The alternative wasn't designed to replace anything overnight.
It was designed to make dependence optional. And February 2nd was the moment that optionality stopped being theoretical. It didn't arrive with a headline. It arrived through behavior. Who sold? Who waited? Who took delivery? That's where this story truly begins. Reserve currency transitions don't happen the way most people imagine. They don't begin with announcements. They don't arrive with ceremonies, and they don't declare winners and losers in real time. They happen quietly, inside systems most people never see. February 2nd didn't matter because prices fell. Prices fall all the time. What mattered was how different systems responded under stress, and what those responses revealed about their underlying design. To understand why that matters, you have to separate money as belief from money as structure. For decades, the global financial system has relied on belief. Belief that liquidity would always be available. Belief that refinancing would remain cheap. Belief that intervention would arrive before damage became irreversible. That belief wasn't irrational. It was trained. Every crisis reinforced it. When markets seized in the past, central banks stepped in. When banks wobbled, credit lines expanded. When confidence dipped, reassurance followed. Over time, belief hardened into expectation, and expectation became infrastructure. Leverage increased because rescue felt guaranteed. Debt expanded because refinancing felt automatic. Institutions optimized for efficiency, not resilience, because resilience had never been tested without intervention. That's what made February different. Not the stress, but the response.
This time there was no immediate softening, no promise that relief was imminent, no signal that discipline would be abandoned at the first sign of discomfort. That absence forced systems to reveal what they were built on. Some systems reacted violently, others barely reacted at all. That difference exposes how reserve systems actually change, not through collapse, but through optional alternatives becoming viable. For years, discussion about a new reserve currency focused on the wrong question. People asked, what replaces the dollar? That framing assumed a winner-takes-all outcome, one dominant currency falling, another rising in its place. But modern systems don't shift that way. They fragment. The real question was never replacement, it was exclusivity. The dollar's power wasn't just trust, it was necessity. Global trade had to pass through it. Settlement required it. Reserves defaulted to it. When something is mandatory, it can survive mistakes. When something becomes optional, it can't. That's the quiet shift underway. What has emerged over the past several years isn't a new everyday currency. It isn't something consumers spend or save. It's a settlement framework, a way for trade to clear without depending entirely on one nation's monetary policy. That distinction matters more than most people realize. Reserve systems don't need to be used everywhere to matter. They only need to be used where pressure concentrates: energy, commodities, bilateral trade between large producers. If even a portion of global trade settles outside the dollar system, the consequences ripple backward. Dollar circulation slows, surplus recycling weakens, automatic demand softens, and when circulation weakens, systems built on constant flow start to strain.
This isn't ideology, it's plumbing. For decades, trade settled in dollars meant surplus dollars flowed back into U.S. assets. Treasury markets absorbed them, banks recycled them, credit expanded. That loop allowed the system to carry enormous debt loads without immediate consequences. When even part of that loop breaks, the effects don't show up as headlines. They show up as friction. Deposits thin, funding costs rise, refinancing windows narrow. At first, nothing breaks. Then things stiffen. Banks don't fail immediately. They become cautious. Corporations don't default immediately. They delay. Governments don't collapse. They issue more debt at higher cost. Stress migrates, and migration is slow enough to ignore until it isn't. This is why February's shock wasn't contained to metals. It revealed pressure across the system, and it highlighted the difference between systems that assume liquidity and systems that assume limits. One relies on intervention when stress becomes unbearable. The other relies on structure to absorb stress without negotiation. Neither is painless, but they fail differently. Systems built on belief fail suddenly when belief breaks. Systems built on constraint feel uncomfortable constantly, but rarely snap. That's the trade-off now confronting global finance. Hardening the dollar is a logical response to erosion. Scarcity restores discipline. Discipline restores credibility. Credibility restores demand. In theory. In practice, scarcity raises the cost of everything built on abundance. Debt becomes heavier. Refinancing becomes selective. Political tolerance gets tested. Markets can absorb restraint longer than societies can. And when restraint begins colliding with employment, housing, and pensions, pressure doesn't stay financial. It turns political. That's the risk embedded in discipline-first strategies. They work until they don't. And when they don't, reversal tends to be sudden. This is where the alternative framework gains quiet strength, not because it promises comfort, but because it doesn't promise more than it can deliver. A system partially anchored to physical backing doesn't eliminate volatility. It doesn't guarantee growth. It doesn't smooth cycles. It simply refuses to pretend limits don't exist. That refusal makes it inefficient in good times and resilient in bad ones. February exposed this contrast clearly. While Western markets interpreted falling prices as failure, other systems treated the same movement as transfer. Claims were being unwound, ownership was being consolidated, paper markets were clearing leverage, physical markets were securing inventory. That divergence matters more than price, because reserve power isn't determined by charts, it's determined by behavior under stress. Who panics? Who waits? Who demands delivery? Those responses reveal which systems rely on reassurance and which rely on arithmetic. This is why reserve transitions feel boring in real time. Nothing dramatic announces them. They happen through repetition. Each trade settled differently, each reserve adjustment made quietly, each institution reducing exposure incrementally. By the time narratives catch up, behavior has already changed. February wasn't the turning point. It was confirmation. Confirmation that exclusivity is fading. Confirmation that alternatives don't need permission. Confirmation that discipline now competes with endurance. This doesn't mean the dollar disappears. It means it has to perform.
Mistakes cost more when alternatives exist. Intervention works, but at higher expense. Force can maintain confidence, but not indefinitely. Optionality changes everything. And optionality, once introduced, never fully disappears. This is why the conflict isn't playing out as a race. It's playing out as a test of tolerance. Which system can function when belief becomes conditional? Which can operate without constant rescue? Which bends without demanding trust? Those answers won't come from theory. They'll come from stress. And stress isn't a moment anymore. It's a condition. When pressure enters a system, it doesn't spread evenly. It migrates. This is one of the most misunderstood aspects of financial stress. People expect explosions, sudden crashes, dramatic failures, clear villains. But modern systems rarely break that way. They stiffen first. February 2nd wasn't a breaking point. It was a pressure test. And like all pressure tests, it revealed where tension was already concentrated. The first misconception is that stress hits speculators first. Speculators feel pain early, but they aren't the weakest link. They are flexible. They cut losses. They exit. They move on. The weakest points are institutions built on assumptions of smooth flow, places where money isn't supposed to hesitate. Banks are the clearest example. Banks don't fail because assets go to zero. They fail because funding stops moving. Deposits slow. Interbank lending tightens. Collateral becomes suspect. What used to be routine becomes conditional. This is how restraint actually damages systems, not through ideology, through plumbing. When dollar circulation slows, the first effect isn't default, it's hesitation. Risk committees tighten standards, credit lines that were assumed or suddenly reviewed. Refinancing requires negotiation instead of paperwork. Each delay seems minor. Together, they compound. Corporations feel this next. Most large companies don't pay off debt. They roll it. They refinance continuously. Their balance sheets assume access to cheap, predictable funding. When that assumption weakens, behavior changes. Investment slows. Hiring pauses. Expansion plans get shelved. Not because demand collapsed, but because financing became uncertain. This is how financial stress leaks into the real economy without a crash. Households don't see it immediately. They feel it later through slower job growth, tighter lending, rising costs. By the time stress reaches consumers, it's already embedded. Governments are not immune. Modern states operate on rollover logic. Debt matures and is replaced. Stability depends not on repayment, but on confidence that markets will always absorb issuance. When global dollar demand weakens, borrowing costs rise, not explosively, but persistently. Budgets tighten,
trade-offs become political. Programs once assumed untouchable get questioned. This is where discipline collides with democracy. Economic theory assumes restraint is rational. Societies tolerate restraint only while pain feels abstract. When restraint becomes visible, unemployment, housing pressure, pension strain, support erodes quickly. This is why hard money regimes historically fail, not because they're wrong, but because they demand endurance. Endurance is political, not economic. February didn't create these pressures. It revealed that they are already in motion. The stress didn't originate in metals. Metals merely showed where leverage had accumulated. The real story was how quickly liquidity disappeared once belief weakened. This is why the price action mattered less than the response. Some systems immediately sought relief. Others adjusted without negotiation. That distinction exposes the deeper difference between belief-based systems and structure-based systems. Belief-based systems require reassurance. When reassurance is delayed, stress compounds. Markets don't wait patiently for certainty. They punish hesitation. Structure-based systems don't require reassurance. They assume volatility. They assume stress. They don't promise comfort. They promise continuity. That doesn't make them superior. It makes them tolerant. This is why gold re-enters the conversation whenever stress migrates. Not because it's stable, but because it doesn't depend on anyone's promise. Gold doesn't prevent volatility. It survives it. This is the key misunderstanding.
People expect anchors to be calm, but anchors exist to hold under force, not to avoid it. When leverage unwinds, prices swing violently. That doesn't disqualify gold as an anchor. It proves it's being tested. What matters isn't the chart, it's custody. During February's turmoil, paper claims collapsed easily. Physical demand did not. This is where the divergence between price and value becomes visible. Paper markets are efficient until they aren't. They clear risk quickly, but at the cost of stability. Physical markets move slowly, but they don't evaporate under pressure. The buyers stepping in weren't speculating. They were securing optionality. Optionality is the real currency of stress. When systems strain, those with options survive longer. Those without them adapt or fail. This is why reserve power is shifting gradually rather than dramatically. No one is declaring independence from the dollar. They're reducing dependency. Each alternative settlement path adds friction to dominance. Each diversification reduces vulnerability. None of it requires confrontation. It's preparation, not rebellion. This is also why the transition feels unsatisfying to watch. There's no climax, just accumulation. Behavior changes before beliefs do. Institutions move before narratives shift. By the time the public notices, the system is already different. February accelerated that process. It forced choices. Who held through volatility? Who sold to meet margin? Who demanded delivery? Those decisions matter more than commentary. Stress exposes priorities, and priorities shape systems. This is why the real breakpoints aren't markets. They're assumptions. Assumptions about infinite liquidity. Assumptions about automatic rescue. Assumptions about painless discipline. Once those assumptions weaken, systems adapt or resist. Resistance buys time. Adaptation builds resilience. The coming years will test which response dominates, not through collapse, but through accumulation of pressure. Stress doesn't need to explode to be effective. It only needs to persist. And persistence favors structures built for limits. This is where the conflict becomes clear. On one side, systems trying to restore credibility by enforcing scarcity after decades of abundance. On the other, systems that embedded scarcity from the start. One must convince people to accept pain. The other assumes pain is unavoidable. Neither path is easy, but only one aligns expectations with reality. That alignment determines endurance.
February didn't answer who wins, it revealed who bleeds first. And bleeding in complex systems is rarely fatal immediately. It's cumulative. The outcome won't be decided by one crash or one policy shift. It will be decided by which systems continue functioning when stress stops being news and starts being normal. Stability is often mistaken for strength. In reality, stability is usually a side effect of intervention. When volatility is suppressed, prices move smoothly. When risk is absorbed by policy, markets appear calm. Over time, that calm becomes comforting and dangerous. February 2nd disrupted that comfort, not because volatility appeared, but because support did not. That absence forced a reevaluation of what stability actually means. For decades, modern financial systems were optimized to minimize visible pain. When markets wobbled, liquidity was added. When credit tightened, rules were softened. When confidence dipped, reassurance followed. This approach worked remarkably well. It smoothed cycles. It reduced short-term suffering. It encouraged growth. But it also trained behavior around an assumption that pain would always be interrupted before becoming structural. That assumption is now under strain. Discipline is returning, not because policymakers suddenly prefer hardship, but because the cost of avoidance has grown too high. Debt levels limit flexibility. Inflation exposes trade-offs. Demographics reduce tolerance for instability. Geopolitics restrict coordination. Together, these forces narrow the margin for intervention. When discipline re-enters a system after long absence, it feels brutal, not because it's excessive, but because expectations were calibrated for softness. This is where gold becomes misunderstood. Gold is often criticized for being volatile, for failing to protect investors during sharp drawdowns, for behaving like a risk asset when stress hits. These criticisms miss the point. Gold is designed to exist without permission.
Volatility is not a flaw. It's a consequence of interaction with leveraged systems. When leverage unwinds, everything tied to it moves violently. Gold is no exception. What matters is not that its price moves, but that it continues to function without relying on rescue. This is why gold reappears in periods of transition, not as a trade, not as a hedge against daily moves, but as a neutral reference point when trust thins. In belief-based systems, stability depends on confidence being continuously reinforced. In structure-based systems, stability comes from constraints that prevent runaway behavior. Gold represents constraint. It doesn't grow. It doesn't respond to stimulus. It doesn't accelerate with optimism. That makes it inefficient during expansions and valuable during resets. This is why systems partially anchored to gold behave differently under stress. They don't promise smooth outcomes, they promise continuity. When prices fall, the system recalculates. When currencies weaken, the anchor compensates. When confidence wavers, structure absorbs. This doesn't prevent pain, it redistributes it. Rather than concentrating stress into a single event, it spreads it over time. Volatility replaces collapse. Adjustment replaces denial. That trade-off is uncomfortable, but survivable. February illustrated this distinction clearly. Western markets experienced sharp price moves because they were clearing years of accumulated leverage. Physical demand, meanwhile, reflected long-term planning rather than short-term positioning. Those stepping in weren't reacting emotionally. They were responding to incentives created by forced selling. This is where the illusion of stability breaks. Smooth charts can coexist with fragility. Violent charts can coexist with resilience. Stability achieved through suppression creates hidden stress. Volatility that reflects adjustment releases it. This is why discipline feels destabilizing at first. It removes the cushion. And when cushions disappear, structures reveal their true load-bearing capacity. The dollar's attempt to reassert discipline follows this logic. Scarcity restores meaning. Restraint restores credibility. Credibility restores demand. But discipline also raises costs, financially and socially.
Borrowing becomes harder, refinancing becomes selective, political tolerance thins. There is a limit to how much discipline societies accept, regardless of theory. This is why discipline-based systems face an endurance problem. They require sustained acceptance of pain. Gold-anchored frameworks face a different challenge. They don't eliminate pain, but they normalize it. They don't rely on belief that intervention will arrive. They assume stress will recur. That assumption changes behavior. Leverage stays lower. Expectations stay conservative. Failure is priced in rather than denied. This doesn't create prosperity by itself. It creates survivability. The illusion that stability equals safety is one of the most persistent errors in modern finance. True safety comes from alignment between expectations and reality. When systems promise more than they can deliver, they eventually break trust. When systems promise less but deliver consistently, they endure. February wasn't a referendum on gold's price. It was a referendum on how systems behave when support hesitates. And what it revealed was uncomfortable. Markets built on reassurance react violently when reassurance is absent. Systems built on constraint continue operating even when conditions deteriorate. Neither outcome is painless, but only one avoids surprise. This is why gold's role isn't about performance, it's about reference. It provides a measuring stick independent of policy cycles. It allows systems to recalibrate without negotiation. It exists whether confidence is high or low. That neutrality is its strength. As discipline returns and volatility persists, more systems will be forced to choose between suppressing pain and absorbing it. Suppression buys time. Absorption builds resilience. The illusion of stability favors suppression. Reality favors absorption. February cracked that illusion, not completely, but enough to change behavior. And once behavior changes, systems follow. Most conflicts end the way they begin, with misunderstanding. The war for the next world reserve currency isn't a battle for domination. It isn't a zero-sum contest where one system collapses and another one takes its place overnight. It's a redefinition of endurance.
The mistake many observers make is assuming that winning means replacing the dollar. That assumption carries old logic, imperial logic, where power is centralized, exclusive, and enforced. Modern systems don't break that way. They diversify. The real outcome isn't victory or defeat, it's optionality. Optionality is the ability to operate when conditions change, to settle trade without permission, to hold value without constant reassurance, to function when belief becomes conditional. Once optionality exists, exclusivity disappears. And exclusivity, not usage, is what gave reserve systems their power. The dollar doesn't need to collapse for this shift to matter. It only needs to lose its status as the only viable pathway. The moment alternatives become usable, behavior changes, quietly, incrementally, irreversibly. This is already happening. Some trade still settles in dollars. Some doesn't. Some reserves remain concentrated. Others are diversified quietly. No announcement is required. Each decision reduces dependency. Each alternative path reduces vulnerability. That's how systems evolve, not through rebellion, but through preparation. This is why the future won't deliver a clean ending. There will be no ceremony declaring the new reserve king, no single event that historians circle in red ink. Instead, there will be a gradual normalization of plurality. Multiple settlement systems, multiple reserve strategies, multiple definitions of safety. Efficiency will decline, redundancy will rise. That trade-off defines the next era. Efficiency thrives under certainty. Redundancy survives under stress. The past few decades rewarded efficiency. The coming decades will reward resilience. This doesn't mean growth disappears. It means growth becomes constrained, and constraints change psychology. When expansion isn't guaranteed, leverage is reconsidered. When rescue isn't automatic, risk is priced differently.
When dominance isn't exclusive, power becomes conditional. This is uncomfortable but stabilizing. The dollar, hardened by restraint, may regain strength. It may reassert credibility. It may remain dominant in many areas, but it will no longer be unchallenged by default. And that alone changes everything, because systems behave differently when they must perform rather than assume. Mistakes become expensive. Delays matter. Credibility must be earned continuously. That pressure isn't fatal, it's disciplining. On the other side, alternative frameworks won't deliver miracles. They won't eliminate volatility or guarantee prosperity. They won't remove political risk or human error. They simply remove dependency on belief. They operate on structure, not on confidence, and structure endures stress better than sentiment. This is why the transition feels unsatisfying to watch. There's no drama, no collapse, no clear villain, just adjustment. Capital reallocates gradually. Institutions hedge exposure. Governments explore options quietly. Central banks diversify without explanation. Years later, the change becomes obvious, not because something broke, but because behavior shifted. February 2nd will be remembered not as a crash, but as a reveal. It revealed where leverage had accumulated. It revealed how quickly liquidity can vanish. It revealed which systems require reassurance and which don't. Most importantly, it revealed that the world is no longer organized around a single assumption. That assumption, that stability will always be enforced, has weakened. In its place is something less comfortable but more honest. Limits exist. Stress recurs. Adaptation matters. This is why the final outcome isn't collapse or conquest, it's maturity. A system that can only function under ideal conditions is fragile. A system that accepts friction, volatility, and constraint is resilient. The next reserve era will not be defined by dominance. It will be defined by coexistence, by systems that overlap, compete, and constrain one another, by institutions that hedge instead of commit blindly, by participants who remember stress and plan accordingly. This won't make the world simpler, it will make it sturdier. And that's the real lesson of February. Not that something failed, but that something changed. Belief alone is no longer sufficient. Force is more expensive. Structure matters. The ledger is still open. Entries are still being written. No final balance has been struck, but the direction is clear. From certainty to conditionality, from dominance to optionality, from belief to structure. That's how this ends. Not with a winner announced, but with systems that endure when belief is no longer enough.